in the office, guys. We're in the office. This is another day in the life of some industrial brokers, commercial brokers. And the scenario here is we got a call yesterday. It was actually a lead that came in online on our website. If you want to go on our website, we have some great information at SoCalWarehouse.com or RevivalEstates.com on commercial real estate. But all to say, somebody came in. It's a retail site. It's currently leased out. And Angel is going to give us some more information after he spoke with the seller, potential seller, the owner of the property, and what they want to do and how we can help them.
Right. So it's very important before you even start running an analysis on the property to get the correct specs, right? Get the square footage, get the land square footage, see the property, that way you can properly compare it to similar properties, right? In this case, this is a grocery store.
I want to say something to what Andrew just said. That is absolutely true. You can't take my word as gold on a phone call. I could be telling you I own this property on 123 Main Street and it's 5,000 square feet, but when Angel goes on to the county assessor's site and verifies the square footage per what's on title and it's 4,575 square feet, well, there's a delta there, right? And that 100, 200 square feet has its value. It's literally value, right? So we have to verify the square footage. So what he said is step number one: verify the square footage, verify the land, and determine where the value is being derived from. Is it the building or the land? So
right.
It's a great.
Right. So right off the bat, the analysis that we got from our county assessor's office is the building is 16,000 square feet and 137 square feet total, and the land is 29,719 square feet, right? So there's a couple variety of ways to evaluate a property, right? When it comes to commercial, you can do the income approach or just the sale comparison approach. And I'm gonna go through each one of those. That way you can get a good idea of what those pertain to. So right off the bat, I'm gonna do the sales comparison approach. This is usually what you see with a lot of residential properties being sold. An example of this is house A, house B on the same block sold for $900,000, $925,000. So it's safe to say that your house, if you're on the same block, is worth around that range as well. That's in basic terms, a sale comparison approach here. So that's what we did for this property, and what we got was
We have average price per square foot right here, and the average price per square foot, we're looking at about $337 per square foot. Okay, so like Angel mentioned, these are based on sales comparable in the zoning, comparable in the vintage of the property. So at $337 per square foot, Angel already verified the building square footage was 16,137. That gives us a valuation of $5,438,000.
right.
$5,438,000 based on the comparable approach, based on the sales comps on that area. And like Angel also mentioned, in commercial real estate, that is not the only way to value a property. There's another approach, and that is the income approach, valuing it based on how much revenue this property is generating, and also taking into consideration the expenses.
Right. So going through the income approach, this is very important for anyone looking to analyze properties that have income, right? Whether you're buying something that has tenants inside or you're buying something that you're looking to put tenants inside into. So it's very important to analyze this correctly. So the important thing to know about this property is that the owner does occupy the building and leases it out to himself. So he doesn't necessarily pay rent. He pays himself a mortgage. He pays his own mortgage through his lease. So he doesn't have an actual lease. So what we did is we ran an analysis of what that property can lease for. And we got $1.92 per square feet.
$1.92. Let's keep it simple. $2. Just for the sake of getting some round numbers here. $2 a square foot.
So at $2, 16,137, you're getting monthly $32,274.
$32,274.
So annually, and it's important to do annually, right? Because you're going to be evaluating it based on the annual income, not just the monthly income. You're going to multiply by 12, and that is 12 months. So you're going to get a total of $387,288.
$387,000. $387,000.
And from there, it's very important. Some people would use this number and go ahead and divide it or base it off a cap rate. What is a cap rate? That's an average return that an investor would spend on the property. And this all determines on the market and the area. So the type of asset will differentiate. The type of asset will vary from location and building due to the type of building it is, if it has renovations, Class A, Class B, and the type of tenant it has as well, because it all determines from risk, right? The more risk you have, the more reward you should have, the more return, and the less risk, the less return you should have.
So essentially, a older building will have a higher cap, have a higher cap rate, have a higher return for someone that's looking to buy it, versus a property that's stabilized. It's core, Class A, new build. It's gonna yield a lower return for someone that's looking to park their money, because it's just less of a risk, right? There's less of a risk of the roof coming in. So Angel explained that very, very nicely. And yes, every different type of property based on different locations, different states, different cities within the state, different corridors are going to have different cap rates, right? So we're going to value this, like Angel was saying, the $387,000 of revenue that it's generating is not the end number that you want to take into consideration when you're about to value it based on the going cap rate. You also have to take what's called an expense ratio. Okay, so any lender, conventional lender, is going to take anywhere from a 30 to 35 expense ratio. What does that consist of? Although the tenant is paying all utilities in this case, there's expenses such as insurance, there's expenses such as property taxes, and depending on the property, there's probably other expenses, maintenance, and a lender's going to take a standard 30 to 35%. We'll do a standard 30% on this $387,000.
So I'm multiplying it by 0.7 because I want 70% of the value.
Correct. Since
30% is going to expenses.
70% of the income of the 387. 70%
right.
of that revenue.
So we get $271,000.
$271,000. Let's write it down. $271,000. That is what you call your NOI, net operating income. Net. That's what the owner would be keeping in his pocket at the end of the year. And this is pre-tax, okay? This is not taking into consideration the taxes, the actual income taxes paid on this passive income. But for simple terms, we're going to take the value. We're going to value the property based on this net operating income and the going cap rate. Do we have an idea what the going cap rate is, Angel?
Right. So we did run an analysis on the going cap rate for comparable properties, and you're looking at 6.4% of a cap rate.
Sounds about right to me.
Right.
For a retail site.
And this varies between market, buildings, as well as just time periods. These are cycles.
If you want to know what the market cap rate for your property is, don't hesitate to reach out. You can reach out directly on this video. Call us at 562-273-9375 or send us an email at info@socalwarehouse.com. Let's keep going.
So dividing it by 6.4%, you're getting a value of 4.23.
Yeah. $4,235,000. $4,235,000. Okay, so now Angel ran the evaluation based on the income approach. He also ran the evaluation based on the sale comp approach. And we have two complete different values. The first one on the comparable approach was $5.4 million. The second one was on the income approach for $4.3 million. That's a significant difference, guys. That's over $1 million in value difference. So a couple things to be aware of. Okay, so ideally, perfect scenario is to sell it for the owner is to sell it on the sell comp approach, right? Sell it off that and $37 per square foot. But what's the caveat? Why may that not be achievable? Well, there's a tenant in the property, right? There's a tenant with a lease. The owner can't just kick the tenant out. He could buy the tenant out off their lease, and if it makes sense, it may make sense to buy them off. If the buyout will be $300,000 to get them out, well, that will make sense, because otherwise he'll have to sell it for the income approach at 4.3, and that's
$1 million less.
Yeah, it's that $300,000 buyout. It makes complete sense to be able to achieve 5.4, right? 5.4. So, and then on the other hand, what I see here is that the rents are undervalued. His current rent is below market. It must be below market if that spread is that much between the income and the sales approach. It should not be that high of a spread, much of a spread. All to say, these are just a quick valuation on a property that just came in. And if you have a commercial property that you would like to get valued, do not hesitate to reach out. You can comment directly on wherever you're watching this video, or you can call us at 562-273-9375, or send us an email at info@socalwarehouse.com. We look forward to seeing you in the next one and talking to you very soon.